Welcome to Module 6.55. Today, we are diving into a crucial topic that often separates the pros from the amateurs: trading psychology and stock selection. We will start by unpacking the mental game of trading before moving on to how to pick the right stocks.
So, what exactly is trading psychology? At its core, it refers to the mental and emotional factors that dictate a trader's decisions and behavior. You can master all the technical and fundamental analysis in the world, but without a solid grasp on your psychology, survival in the markets is incredibly tough.
While many traders focus obsessively on learning charts and fundamentals, it is actually trading psychology that separates successful traders from the rest. Your mindset is the ultimate filter through which all your strategies must pass. Let's talk about the specific emotions that hijack our trading plans. Fear, greed, excitement, and frustration are the usual suspects. These intense feelings are what drive traders to make impulsive, poorly thought-out decisions most of the time. A classic example of this is FOMO, or the fear of missing out. Imagine seeing the market ticking upward, or watching everyone else buy a particular stock. Even if that stock doesn't fit your strategy, the urge to jump in becomes overwhelming. In that moment, your psychology is telling you, I need to buy now because it's going higher. If I don't, I'll miss a huge opportunity. You end up taking risks on stocks that violate your own rules just because everyone else is doing it. But what happens if you act on that FOMO? Most of the time, you will be wrong. And that leads us to another dangerous emotion: greed. You buy a stock, set a target, and then it hits the target. But instead of selling, you hold. Why? Because market rumors and fake demands start spreading, convincing you the price will go even higher. Your psychology shifts to just hold it, ignoring your original plan.
And while you hold, hoping for more, the stock can easily plummet. You missed your exit, and suddenly a profitable trade turns into a loss. You tell yourself you'll sell when it goes back up, but it rarely does. It often falls even below your initial buying zone.
This brings us to emotional decision-making, specifically panic selling. Imagine the market is falling due to some bad news. The sea of red on your screen triggers pure panic. In this situation, traders often exit their positions even before their predefined stop losses hit. This is a terrible habit. When you enter a trade, you have a strategy, a stop loss, and a target. As long as the price is in that range, you should hold. But seeing everyone else panic causes you to abandon your strategy and sell prematurely. You let the market's emotion dictate your actions, rather than your own predefined plan. And what often follows a loss, whether from panic selling or a hit stop loss? Revenge trading. Your stop loss is hit, and immediately you feel the burning need to cover that loss right away. To get that money back, you immediately jump into another stock without doing any proper research. You take on risk purely out of a desire for revenge against the market. When you take a trade for revenge, without deep research, proper trade management, or risk management, the possibility of failure is extremely high. Most of the time, these trades fail miserably. To survive and thrive, you must build on the right foundation. Discipline, patience, and emotional control are the bedrock of successful trading psychology. If you lack discipline, if you lack patience, if you cannot control your emotions, you simply cannot survive here. A trader with a strong mindset builds their strategy first and then executes it with unwavering focus. We'll explore how to build that strategy next. Picking up from the idea that trading is as much mental as it is technical, the material argues that discipline, patience, and emotional control are the foundation of successful trading psychology. If a trader can't follow rules, can't wait, and can't manage emotions, they simply won't survive in markets. The point isn't perfection, it's building a mindset strong enough to act consistently under uncertainty. A useful way to read this as a chain reaction. When discipline is missing, emotions take over. When emotions take over, behavior becomes inconsistent, and then even a good idea gets executed poorly. The material is emphasizing that the trader's first job is not to predict perfectly, but to behave predictably, meaning follow pre-made rules instead of reacting to fear, greed, or noise.
Next, the material describes what a strong mindset trader actually does in practice. First, they build a strategy. Second, they only take risk in stocks that fit that strategy, rather than chasing whatever is moving. That filtering step is discipline in action. It prevents random trades. It also frames trading as a repeatable process, not a series of emotional guesses.
Notice not following other ways, meaning external tips, hype, or last-minute changes that conflict with the plan.
The key message is if a trader already defined the plan, the best move is usually to follow that plan, not to keep rewriting it in the middle of the trade because someone said something or the price moved quickly.
The source material gets very concrete about planning. If someone is buying a stock, they should decide in advance. If price falls to a certain level, they will sell with a small loss. And if the target is reached, they will sell at the planned profit level. Those decisions, stop loss and target, should be fixed before entering, not invented later under stress. This decide before you buy framing matters, because once money is at risk, the brain tends to defend the position emotionally. By predefining the exit points, the trader reduces negotiation with themselves. It's not about being right every time. It's about making losing trades small and making winning trades systematic, so the overall process can survive over many trades. Then comes the key idea. The market is unpredictable, especially in the short term. No one truly knows whether it will go up or down tomorrow. Volatility can spike for many reasons: company news, the country situation, and political instability. The trader cannot control these waves. The only controllable thing is the trader's own behavior, how they manage the trade. That line, "you can't control the outcome of every trade, but you can control your behavior," is the psychological pivot. It shifts the goal from prediction to process. If a trader tries to control outcomes, they'll overtrade or revenge trade. If they focus on behavior, entries, exits, sizing, and rule following, they can stay consistent even when the external environment is chaotic. The material also distinguishes time horizons. It suggests that in midterm scenarios, a trader might be right more often, but in the short term, the market can be extremely volatile and hard to predict. This isn't a promise that midterm is easy, just an acknowledgement that short-term price moves are often dominated by noise, reactions, and sudden events. So visually, the red zone represents where emotions get triggered most: fast moves, sudden candles, quick reversals. The blue zone represents where patience can matter more, letting a thesis play out without reacting to every tick. The practical lesson is to match expectations and trade management to the time horizon, because the type of uncertainty changes with the time frame. A big psychological point here is that small growth can beat aggressive growth. Traders with very high expectations tend to take more risk. That higher risk increases the chance of large drawdowns or blowups. In contrast, if expectations are realistic and gains are consistent, the trader can progress steadily and often outperform the majority of traders over time. The message is not that ambition is bad. It's that unrealistic expectations usually force reckless position sizing, poor stop discipline, or chasing trades. The consistency wins idea is essentially about survival and repeatability, staying in the game long enough for skill and probability to work, rather than gambling on a few huge wins. The source gives a concrete example of disciplined risk-reward, keeping a fixed risk-reward like 1 to 2. For instance, risking 2 to 3% on a trade while targeting 4 to 6% can be acceptable. The core is that risk and reward are defined, not improvised. This creates structure. Even if a trader is wrong sometimes, the math can still work.
This also implies a sequencing rule. Define the stop loss and the amount you're willing to lose first, and only then decide position size. That approach prevents the common mistake of buying a random quantity and hoping the market cooperates. With fixed risk, decisions get calmer because the worst-case scenario is already accepted and planned for.
Another concrete benchmark in the material is monthly consistency. If someone can grow their portfolio by roughly 5 to 6% per month, they'll be ahead of most traders. Specifically, it claims ahead of about 90%. The emphasis is that this isn't easy or automatic. It requires patience, discipline, and consistency in following the trading plan. The not instant reminder matters because many traders abandon good processes when results aren't immediate. The material is pushing a longer-term mindset. Consistent execution and moderate growth can be a powerful edge. The checklist is basically the behavioral requirements to make that steady curve realistic. Without them, performance tends to become uneven and emotionally driven. The text anticipates skepticism. Some people may not believe in small, steady growth. It answers with compounding. If growth is consistent, compounding starts to do real work. The key is that compounding doesn't reward random spikes. It rewards repeatable gains over time. So the focus becomes maintaining consistency rather than chasing a single huge month. That comparison highlights a practical truth. Big swings can look exciting, but often reduce the final result because large losses are hard to recover from. A consistent path, even if slower, can end higher simply because it avoids deep drawdowns. This matches the material's theme that the real advantage is behavioral, sticking to a process that keeps capital intact and allows compounding.
A strong statement in the material is that most traders think success is about finding the best strategy, but there is no single best or always profitable strategy. Instead, trading is mostly about managing psychology and protecting capital. In other words, the edge comes less from a magical setup and more from consistent execution, risk control, and emotional stability.
Survival first is the mindset behind this. If capital is protected, the trader gets many chances, many traits to let probability play out. If capital is not protected, one bad period can end the whole journey. The cracked trophy is a reminder that chasing the perfect strategy can distract from the basics, sizing, stops, and the discipline to follow rules. The material also normalizes losses. Losses are part of the game, and hitting a stop loss shouldn't create extreme frustration because the stop was planned. If long-term consistency is maintained, the trader can still win overall, even with many losing trades. That's an important psychological shift. Stop losses are not failures, they're protective decisions.
Calling it control damage is exactly the intent. A planned loss keeps the trader emotionally and financially stable for the next opportunity. The warning against revenge trading is implied. When traders get frustrated, they often break rules to recover quickly. The material's advice is to treat stop-loss hits as routine, just one data point in a long series.
Another key line is that trading psychology depends on the individual, specifically on how they manage trades. The speaker can suggest principles, but the trader's outcome depends on whether they actually define management rules and follow them. So psychology isn't just motivation, it's operational. It shows up in concrete behaviors: planning, waiting, exiting, and controlling risk.
Exit rules and risk per trade are highlighted because they're where emotions typically cause the most damage: holding losers too long, taking profits too early, or oversizing positions. By tightening these two areas, a trader often stabilizes their psychology automatically. When the rules are clear, the brain has fewer moments where it can bargain, hesitate, or panic.
The material gives a straightforward suggestion. Before taking risk in any stock, first define how the trade will be managed. Decide how far it can fall before cutting the loss, and stay fixed on targets. This is essentially a pre-commitment device. The trader is making decisions while calm, so that later, when price moves, there's less chance of emotional improvisation. The write it down cue strengthens the same idea. When rules are only in your head, they're easy to bend. Written rules create accountability, either to yourself or to a journal. The deeper point is that disciplined trading is not just knowing what to do, it's designing a process that makes it harder to break your own rules under pressure. Now, the material describes what to do after entering. If a trader buys a stock with a target above and a stop loss below, then as long as the price stays inside that range, the instruction is simple: just wait and watch. Do nothing. This is patience in action. It prevents overmanaging a trade based on small fluctuations that don't violate the plan. That hands-off mindset is harder than it sounds because the environment constantly pushes traders to react. News, social media tips, and the urge to monitor every candle. Blurring the distractions reinforces the lesson. Unless price is reaching your predefined levels, your best decision might be no decision. This reduces churn and helps keep execution aligned with the original strategy. If the target is hit, or even near the target, the material suggests profit booking, at least partially. Instead of selling everything at once, a trader can scale out, take some profit at the target zone, and if price keeps moving up, exit additional portions progressively. The goal is to turn paper profit into realized profit while still allowing participation if the move extends. Those staged exits illustrate the idea without locking you into exact percentages. The principle is incremental harvesting. Reduce risk as the trade works, and avoid the regret cycle of either selling everything too early or holding everything too long. This also supports emotional control, because once some profit is locked in, it's psychologically easier to follow the plan for the remaining position. On the other side, if the stop loss is hit, the instruction is to sell there. The material notes it doesn't have to be 100%, partial selling is acceptable, but the key is action at the stop level, not hesitation. This is the discipline piece again. The stop loss is the boundary of invalidation, and respecting it protects capital and keeps losses small. No negotiation captures the intent. The stop loss is not a suggestion, it's a rule. The lock icon signals that once the plan is set, the trader avoids moving the stop farther away just to avoid being wrong. That behavior, shifting the stop, often turns small planned losses into large unplanned ones, which is exactly what the material is trying to prevent. From here, the material transitions into the next topic, how to select stocks for trading and investment. The first resource mentioned is a website, nepsialpha.com, as a starting point for stock selection. The key is that selection comes after psychology and management rules, because even a good stock pick can fail if the trader doesn't manage entries, exits, and risk properly. So the next section will likely use that site to filter or evaluate candidates. For now, the important continuity is the sequencing. First define how you'll trade, your stop, your targets, your risk, then use tools and websites to find stocks that fit that framework. That way, the tool supports a process rather than driving impulsive trades. Moving right into the practical application, the first step for stock selection is utilizing platforms like Nepsi Alpha. By navigating to their trading signal section, you can filter stocks based on candlestick formations across multiple timeframes, from 5-minute intervals up to monthly charts. For instance, selecting the doji pattern allows us to isolate specific market indecision points. By actively selecting this specific candlestick signal, the platform immediately filters the entire market to show only those equities currently forming this specific pattern. When we pull up a specific result, like MKHL trading at 740, we immediately see fundamental metrics. The EPS sits at 0.83 and the PE ratio is quite high, which generally isn't ideal. However, for short-term trading, we prioritize technical setups over these fundamentals, provided the book value remains somewhat reasonable. Switching over to the technical chart for these filtered stocks, we often find them testing key resistance levels. If you are considering a trade here, you must employ a breakout trading strategy. Your buying zone should be established around the base of the recent red candle, while your profit target aligns strictly with that upper resistance boundary. This green zone represents your optimal entry point, ensuring your risk is managed while aiming for the predetermined resistance target above. Beyond the doji, you should scan for other formations like the bullish engulfing, hammer, or 3 white soldiers. Once technicals are cleared, checking fundamental signals helps identify undervalued assets. Take NBL as an example. It trades near its original book value with a PE ratio around 8, suggesting strong future potential for the stock price to multiply. To refine our list even further, we utilize the technical screener. This tool allows us to filter stocks based on specific indicators like MACD or price position relative to the 200 simple moving average. A highly effective method is setting the RSI filter to a range of 0 to 30, which immediately highlights potentially oversold stocks right for a bounce. Let us look at AKPL from that RSI scan on a TradingView chart. We previously analyzed this stock during a breakout where it successfully hit our first target. When the second target failed to materialize, a trailing stop-loss protected the capital. As we analyze these technical exits, we will next look at how platforms like Chukul handle broader fundamental zones. Notice how the trailing stop-loss triggers precisely here, ensuring that profits from the initial surge are secured, even when the secondary target is missed. Dive right into fundamental analysis by looking at market capitalization trends. If we focus on the banking sector, the first thing to check is whether the earnings per share, or EPS, is positive or negative. For instance, Everest Bank Limited, or EBL, shows a strong positive EPS of 35 and a solid net worth of 235. A low price-to-earnings ratio combined with these metrics makes it a prime candidate for long-term investment. Another excellent example is Nepal Bank Limited. Notice how its current market price sits at 251, but its actual book value or net worth is 260. When a company's stock price is trading below its net worth, it falls into the undervalued category. Alongside a healthy EPS, this makes NBL another fundamentally strong banking stock to consider adding to a long-term investment portfolio. Let us break down the specific metrics for Nepal Bank Limited a bit further. The paid-up capital is substantial at $14.69 billion, and the 180-day average price aligns closely with the current market price. However, we must pay close attention to the non-performing loan ratio, which stands at 5.45%. This is slightly high, indicating that some borrowers are struggling to repay their loans on time. Moving over to the technical chart for NBL, we can identify a distinct support zone where the price has reversed multiple times. While short-term traders might look at the primary resistance level right above, a true long-term investor should aim much higher. A standard rule of thumb for long-term targets in this context is to look for a price that is roughly 3 times the company's net worth.
We can apply this exact same filtering process to other sectors, such as mid-cap hydropower stocks, which often see strong trends. If we sort by net worth, BPCL ranks at the top, followed closely by Sahas. Sahas boasts a net worth of 182 and an EPS of 9, though it does have a relatively high number of floated shares at nearly 37.8 million.
When we check the technicals for Sahas, we see a clear resistance level around 555. The strategy here is to buy near the support zone and place a strict stop loss just below it. By combining fundamental strength with these technical entry points, you drastically improve your risk-to-reward ratio. Over time, analyzing metrics like net worth and EPS across different companies will make stock selection second nature.